Please do not let us disturb the class. Let us enjoy the class as usual so that we can uh, we can be together and enjoy the class together. Please do not disturb the class. If you have a question, please just uh, professionally, please just raise up your hand so that we can attend to the question together instead of disturbing the class. So I will also send the the link. Sorry, excuse me. Hello, Alpha. Hello. I'm fine. Down. Yeah, yeah. Mo wà ní class lọ́wọ́ gan báyìí. Yes, yes, yes. Oh, yeah. Mo tẹ̀ nílò tó 7 gan because we are almost done with this chapter. So I just want to round it up today. All right now. How is work now? Yeah, we'll talk later in the evening. Okay, so let me quickly just forward this YouTube link to some of us that were unable to join through this that were unable to join on the Google Meet directly so that they will also join us. Okay, so let us proceed. Please do not disturb the class. If you have a question, please just raise up your hand so that we'll attend to the question. Then I shall also be asking us some questions, some tricky questions that I will need our attention and our professional judgment on it. So let us begin. Last Wednesday, we have established this very important chapter, very important chapter 14, reporting. What do we mean by reporting? We have explained to ourselves the meaning of reporting is that special document or mode of communication at which the external auditor or an independent auditor communicates its audit work to the client. So the process of communicating this audit work is to express opinion, is to express an opinion on the financial statement review, whether it is of fair view, fairly presented, free from material misstatement, and prepared in accordance with the regulatory requirements. So the purpose of that report is for auditor to give his opinion, his or her opinion on the said financial statement. So having to understand that, we explain to ourselves that naturally there's something we call expectation gap, whereby user of financial statement, they think that by holding that report or by reading in as much as the auditor were able to produce a report on its audit work, that report serves as a certificate that the financial statement is free from error. They also have the expectation that the auditor must have used 100% testing on all the transactions for the current year, and auditor is responsible for detection and prevention of fraud and error. That is where the expectation gap lies. So the expectation gap is the difference between what the user of financial statement thinks that is the responsibility of the auditor and what is statutory responsibility of an auditor. So the element that I just read out now, which means that the public have this mindset or expectation that so far an auditor can present a report, that report serve as an assurance that the financial statement is free from error. They also have this mindset that the auditor is responsible for prevention and detection of fraud and error. And also, they also have this mindset that auditor have used on have tested 100% on all the transactions that occur during the financial year. So, however, thereby make them to rely solely on the reports given to them by the external auditor. That is an expectation gap. Then we'll move forward to response to an expectation gap, that what should the auditor do, or what should the public, what should they be aware of on all these assumptions they have in their head. So response to the expectation gap is by the profession to continually express or let the public know at regular interval that that audit report does not guarantee that the financial statement is free from error. Two, that auditor is not responsible, that the responsibility of prevention and detection of fraud and error lies solely on the management, not the auditor. So, after you understand that, we now move forward to what we call true and fair view as one of the essential elements that used to be present in the auditor's report. What is that true? What is that fair? The true, we are saying that we are creating objective assurance that the information contained in the financial statement is free from error. While fair view is also an objective and assurance. Objective assurance stating that the information in the financial statement are not misleading. That is true and fair view. So, in conjunction together, true and fair view means that the financial statement is free from error, that the information contained therein is not misleading, that the account is prepared in accordance with regulatory requirements, that the account is free from error. So all these things are combined together to form a whole meaning of true and fair view that we use to make reference to whenever we are saying that the financial statement is okay. Then we now move to some elements that must be present in the auditor's report. In the past, audit report always seem to be brief, and most of the information that's supposed to be added or contained in the auditor's report were not present. So then there comes some standards, and there's regulatory requirements that now state and back that although after the opinion has been made, there are also some essential elements that need to be present in our auditor report to call the attention of both the shareholders and the user of the financial statement. Then there comes some standards. In accordance with international standard of audit, then ISA 701, which is key audit matter, is now added. So what is that key audit matter? The key audit matter can be defined as a matter that is very, very significant to the auditors, but does not relate to the financial information. An auditor must be, an auditor wants to bring the attention of the users and the shareholders to that significant matter. What are these examples of this significant matter? Number one, revenue recognition. You can see directly that revenue recognition does not relate to financial information, but however, it is indirectly, because if your revenue is not properly picked in accordance with IFRS 15, there will be issue. So, revenue recognition, impairment of assets. These are the examples of key audit matter that if auditor during their review, they find out that one or two things were not in order in any of these elements that we mentioned, it shall be reported in the auditor's report under key audit matters. Dear professional, please, are you following? I'm trying to like reverse back from what we discussed on Wednesday. Okay. So, key audit matter has been settled. There's another standard. There's another standard that needs to be present in our auditor's report. We call it ISA 706, which is emphasis of matter. So what is this emphasis of matter? Emphasis of matter, they are the matter that are presented and disclosed in the financial statement, whereby the auditor needs to bring to the attention of the users and the shareholder. I say again, emphasis of matter, they are the matter that are disclosed and presented in the financial statement, and the auditor wish to let the user of financial statement and the shareholders be aware of those disclosures. It must be present in our auditor's report, if any, during our review. If you find out anything like that, it has to be reported under emphasis of matter. What are the examples of emphasis of matter? Subsequent events. Subsequent events that can make us to change financial statements or to change some information in financial statements. If they were present, it should be reported as what as emphasis of matter in our audit report. Another example is ISA 570, material uncertainty for going concern. ISA 570 we are still coming to that side. ISA 570 talk about material uncertainty on going concern. It is also an example of emphasis of matter, where the company has been making loss for some years, and you, during your review, you see that it was disclosed in the financial statement. And however, you also need to call the attention of the users and the shareholders to it, that based on the review from the previous year, and the company has been making loss, it probably means that the company might not be able to continue the eternity. If there's any element like that that has been disclosed and presented in the financial statement, you also bring it back under emphasis of matter. So we should not, let's take note, we should not take key audit matter as criteria to give an account modified opinion. What I'm saying is that key audit matter does not mean that the financial, who is this person now? Slimon. How about this is not right now? Come on to just mute your mic. Why did you unmute your mic now? Okay, I will just let it pass. I refuse to be angry this evening. So let us proceed. See another person. Let us proceed. So we should not take key audit matter as a criteria to modify audit opinion. We are still coming to meaning of modify audit opinion. We are still coming there. That is ISA 705. So how do you understand that the key audit matter, emphasis of matter, which is ISA 701 and 706 respectively? Then we also have other matter. What is that other matter? The standard that we talk about other matter is the ISA 706. Other matter, they are the matter other than the matter that have been disclosed and presented in the financial statement. There are also some matter that they are not disclosed or presented in the financial statement. So we call them other matter. So we also, if there is any that you wish to bring to to the attention of the users of the financial statement and the shareholder, you also include it in your auditor's report. So if you understand this and you are following with me, and you are following it, please let me see your MOD so that we can proceed. All right. So after that, we'll move forward to what to very important aspects of this chapter, which is ISA 700, which is what unmodified audit report. What is that unmodified audit report? When we say unmodified audit report, it means that the auditor is telling us that the financial statement is free from material misstatement. It is true and fair view. It is prepared in accordance with regulatory requirements, and it is fairly presented. That is the condition that can warrant an auditor to give an opinion or to give unmodified opinion. When something is unmodified, it means that from your review, nothing has come to your attention that the financial statement is free from material misstatement, that the financial statement is true and fair view, that the financial statement is fairly presented, and the financial statement is free from material, prepared in accordance with regulatory requirements. If these four things have been certified, then an auditor can issue an unmodified audit opinion. So that is the aspect where we stopped last week. So let us proceed. Then we now proceed. Wednesday. Then we now continue from where we stopped. I gave us this summary so that for some people that just joined this class today, while some they did not even understand where we started from Wednesday. From this small explanation, I took my time. I've been taking my time to give us this thing. This chapter, I'm not rushing. That is why I took my time to explain and calm as much as possible so that everybody will understand. So, we now want to continue from where we stopped. Now, what are the requirements in accordance with CAMA that must be present in our auditor's reports when you are giving an unmodified audit opinion? This thing, you can see it as a criteria that can warrant you as an auditor to give an unmodified opinion. So, CAMA now come that if all these things have been certified during your review, you can also what give an unmodified audit opinion. So let us go. Reporting requirements of CAMA. Sorry if you are just joining for the first time. My name is Olatunji Idris. So I'm the regular host. So let us begin. Now, reporting requirements of CAMA 2020 on auditor's report. Now let's go. The auditor's report shall state the matter set out in the 5th schedule of CAMA as follows, telling us invariably that if all these things have been certified, then you can give an unmodified audit opinion. 1. Whether you have obtained all information and explanation, which is to the best of their knowledge and belief where necessary for audit. 2. If in their opinion, books of accounts have been kept by the company. 3. If the company statement of profit or loss and financial position dealt with by the report agree with the books of accounts. 4. Whether in their opinion, information and explanation reflect true and fair view on the financial statement information. So this among other that can warrant an auditor to issue an unmodified audit opinion. Let's go. Another one. In the case of holding company, if the group financial statements have been prepared in accordance with provision of this act to give true and fair view, also the auditor is required to make a report to the audit committee. So after all these things has been met, this condition, this criteria has been met, in accordance with CAMA 2020 Act, then an auditor can issue a can issue an unmodified audit opinion. So who can tell me which standard talks about unmodified audit opinion? You just raise up your hand, just one person, just one person. Which standard that talks about unmodified audit opinion? Oh yeah, oh, just one person. Which standard that talks about unmodified audit opinion? Hey, people started looking. Oh, okay, let me see. Okay, the Esther, please you have the floor. Which standard talks about unmodified audit opinion?
ISA 700.
Thank you. Yes, it means you are following the class. So, please, by now, nothing has come to my attention that everything that I've been teaching since morning, nobody is not understanding. It means that you are giving me unmodified answer that everything I've been explaining since morning, you are getting me. Yes.
Hello, sir. Sorry, what is your question?
I said, which standard talks about unmodified audit opinion? And someone has answered that ISA 700. Okay, thank you. Please, you can kindly mute your mic. Please, mute your mic, everybody. Thank you. Please mute your mic. Okay. So, we have I have substantially explained to my best knowledge, to my best capacity, what you need to know about unmodified audit opinion, ISA 700, the key audit matter, ISA 701, emphasis of matter, ISA 706, other matter, ISA 706 reprise, then the meaning of auditor's report, which other one? Expectation gap, response to the expectation gap. So now we are moving forward. What is modified audit report? You see, as an auditor, you can give modified audit report or audit opinion into when two things happen. First of all, the financial statement must be materially misstated, and two, limitation of scope. If these two elements are present, then you can issue unmodified audit report. I will say it again. Unmodified audit report, a condition that can warrant you an auditor to give unmodified audit report, can come in two ways. One, when the financial statement is materially misstated, and two, when there's limitation of scope. So, how did you know that you are going to give unmodified audit opinion or report? Then
Sir,
this
sorry, I thought you were talking
unmodified.
about modified. So you're saying not modified.
Sorry, you should understand. You should deal with me now. You know that I'm in the realm. Deal with me. It means that I'm still talking about modified audit report. Okay, thank you for that correction. But I meant a modified audit report actually. So what I'm saying in essence is that before you can give modified audit report, two conditions must be present. One, the account is materially misstated, and two, limitation of scope. Then that is the condition that can warrant you to issue modified audit report. So this modified audit report can now come in three times. We have modified opinion, adverse opinion, and disclaimer of opinion. So we are coming there. Sit down and enjoy this class. Apex is doing well. So you have to thank Apex. Let us go. And like I said, modified audit report. An auditor can give modified audit report in two conditions. You can give that, you can say that the account is not free from material misstatement in two when these two elements are present. One, the account is materially misstated. Two, limitation of scope. So I'm going to explain these two things and how you can use it to know on how to give your opinion on the said financial statement. Then I'm now going to ask this question. It's just 5 people I need. 5. After this, I will now ask you the question. Now let's go. A modified audit report is a report issued when the auditor identifies significant issues with financial statement. A modified audit opinion can arise where the auditor is an error, is an error or a disagreement over particular matter or lack of sufficient audit evidence in particular area of financial statement, including disclosure. Before issuing a modified report, the auditor shall discuss with the management the reason for the modification. The reason shall be explained to the management and amendments will be demanded. Following this, if management make necessary adjustments, the auditor will not need a modified report. Also, if the management refuse such amendment, a modified report may be issued. Note, modified report may either have unmodified opinion or a modified opinion. So, the auditor will modify his opinion in the auditor's report in 2 situations: material misstatement and limitation of scope. What they are telling us is that before you can give modified audit report, it means that the account is either materially misstated and there is limitation of scope. But if haven't you understand that, you cannot just go and give modified audit report like that. You consult with the management. You call them. The management of ABC during our audit review will find out so thing. Limitation of scope. Your staff will not give us substantial document that can make us to validate our evidence in order for us to give opinion. So this is the situation at hand. How can we deal with it? So you let the management know. The management will make adjustments and amendments where necessary. So then, if management has corrected it, then there is no reason for you to give modified audit report again. But however, if the management refuses such amendment, a modified report may be used. So now, what is now the situation that might warrant an auditor to give modified audit report? 1, material misstatement. This is where the auditor, based on audit evidence, consider that there is material misstatement in the financial statement. 2, limitation of scope. This is where the auditor is unable to obtain sufficient appropriate evidence to conclude that the financial statement is free from any material misstatement. So, here's my question. How can you have unmodified opinion in a modified audit opinion? Well, that statement, how does it mean that unmodified audit opinion in a modified audit opinion? Just 5 people. So the first 5, I'm going to 1, Bukola Suleya. Hi, Bukola 1. Yes, we other person. Who else? Who else? Who else? Okay, Buki Suleya, my dear friend. We used to fight before, but we are now friends now. Oh yeah, let me hear you.
Hello, can you hear me?
Yes, I can hear you. You are laughing at me. You stop messaging me again. So we are not fighting again, see?
I've been busy studying.
I understand. Oh yeah, now, oh yeah, let's go.
So yeah, regarding the question, you said, how can we find unmodified?
If you are the only one that answered this question to my taste, don't let me say what I have in mind. Oh yeah, let's see. Yes. What does it mean?
Hello?
Suleya, we are waiting for you.
Yeah, can you hear me?
Yes, I can hear you.
Yeah,
Yes.
You said, how can we find unmodified?
I can hear you.
You said, how can
No,
we find?
I said not. It's not how can we find. I said, what does it mean to say that you can have unmodified audit opinion in a modified audit opinion or on a modified audit report? What does it mean to have unmodified audit opinion in a modified audit report.
Okay. Yeah, actually, it
You
means
can see that you are the okay, Mr. Okechukwu, that's the second person. Oh yeah, Surya, I'm listening to you.
okay, yeah, it means that the opinion, it is materially misstated. Unmodified, yeah, it is materially misstated, but the auditor, like they said it is upfront fair view. You said modified and unmodified, right?
No, unmodified in a modified report.
Yeah,
Unmodified
unmodified.
opinion in a modified report.
Yeah, like the opinion is materially misstated initially, but when the auditor will present it, they present it as like it's of true and fair view. So they didn't have it was the statement, the report was not adjusted. So they presented it, but the
No,
initially like
I disagree with you, Surya. Don't worry, I'm coming back to you. Mr. Okechukwu, you have the floor, sir.
Okay, sir. Good evening, sir.
Good evening.
Okay, whereby an auditor can issue unmodified report in a situation of modified situation is that based on the condition being stated, which is material misstatement or scope limitation, if management respond positively based on the limitation of the auditor from getting the sufficient evidence, if the management respond positively, then the auditor can now issue unmodified report in the modified situation.
Your voice is breaking, sir. Is this your okay? Thank you, Mr. Okechukwu. Okay, let's listen to another person. Who is this third person who was Olatunji Ahmad, my namesake? Let's hear you. Ahmad, please, you have the floor.
Good evening, everyone. So
Good
what
evening.
it means is that when the auditor is about to give a modified opinion, but the management was able to bring evidence that or convince the auditor that those the statement that auditor think that they are misstated, they are not actually misstated due to the reason the management give the auditor.
Okay, Mr. Ahmad, thank you.
Yes, sir.
Let's hear the last person. Let's hear the last person. What was this? Isaac, please, you have the floor.
Okay, can you hear me, sir?
I can hear
Can you
you.
hear me, sir? Okay, situation where we can have
I can hear you. Please
a
go on.
okay, situation where we can have a modified report in an unmodified report is where there are maybe disclosures or something that the auditor is trying to point out in the financial statement that he's already seen that is unmodified. Maybe there are areas that he wants them to take a look at. He's not totally condemning what they have done, but maybe there are areas he wanted them to look at first.
Okay, Mr. Isaac, thank you. I think I've attended to Leah, I've attended to Okechukwu, I've attended to Mr. Ahmad, then Isaac. The last person should be Isaac. So the other people, please put down your hand from uh, Mr. Ayansoya, please put down your hand. Efe, please put down your hand. Councilor, please put down your hand. So I only want to attend to Mr. Isaac Jimo. Please, you have the floor.
Good evening, everybody. Can you hear me, sir? Yeah.
Please go on, we can hear you.
In the situation whereby a auditor find that in the statement of financial statement that it has free from error, so that is to modify. It confused. Hello.
I'm listening to you. Mr. Isaac, Mr. Jimo, thank you. Thank you. I think other people 44, but you have the idea. Please, you can mute your mic. Everybody, please put down your hand, please. Stephen, Adam, Olalekan, please put down your hand. Okay. Mr. Isiaq, please put down your hand, sir. So, I want to say thank you for your contribution, everybody. Suliat, Okechukwu, Ahmad, Isaac, and Isiaq. Mr. Isiaq, please put down your hands. Olalekan, Olanike, please put down your hand, please. Okay, so Isaac is close to it, closer. No, like I think he has the idea, and Mr. Isaac has the idea, but not thorough. When we say that unmodified audit opinion in a modified report, opinion is that, for my opinion, what is the criteria to issue an unmodified opinion? That is, you say the account is true and fair view. When the account is true and fair view, means that the account is free from error. Abi, the account is not misleading. The account has been prepared in accordance with regulatory requirements. The accounting policy and disclosure were present. That is the condition to give an account an unmodified opinion, which is true and fair view, in short. But you are given a modified report. It means that after surprising, after like how do I put it? After the trial of fair view has been ascertained, which auditors, in your opinion, says that this account is true and fair view, but you are not giving modified report, in the sense that after the account has been certified that it is true and fair view, but it is materially misstated, meaning that the figures in the financial statement is materially misstated, and the client or the company, they did not give us some document that can substantiate us to have this mindset that we are able to gather substantial and appropriate audit evidence for us to form our opinion. Thereby, we are saying that the account is true and fair view, but is not free from material misstatement due to limitation of scope. So that the reason I did not comment after Suliat was that because Suliat was, I think she has the idea, but the way she put it was totally wrong. Mr. Okechukwu did not get it right. Ahmad did not get it right. Isaac was close to it, but he just conceived it, but he doesn't know how to put it. And Isaac is also not, he also has the idea, but he doesn't know how to put it. Someone said it's confusing. Let me say it again. Unmodified audit opinion. It means that, what is the criteria? This thing is very, very simple. The criteria to give an unmodified audit opinion is when the account is true and fair view. So the true and fair view can be substantially now split into 4 ways. 1, it is free from error. 2, it is not misleading. 3, the account is prepared in accordance with regulatory requirements. 4, appropriate disclosure were present in the financial statement. Then it makes it to be unmodified. It means that the account is true and fair view. It's true and fair. But you are not given a modified report that the figures reported in the financial statement are materially misstated, and also we could not gather appropriate and substantial evidence on which to conclude that the financial statement is not materially misstated. That is why we are given modified audit reports. It means that you are having unmodified opinion in a modified report. Please, are you getting me? Someone should first clap for me first. First of all, clap for me. Even though you have question first, clap for me first before you now ask your question. So if you have a question, please ask your question now. Now ask your question. I know some people will ask. Ask your question. Let me start from Alanike first. Do you have a question? Olanike, you have the floor. If you do, but if you did not, let me move to my friend, which is Bukola. Bukola, please, you have the floor, please.
Yeah,
Yeah,
can you
I
hear
can
me?
hear you. Yes.
Mine is actually not a question, but a clarification. Because
Okay.
what I said was exactly what you said.
What you said was you did not put it right. That makes it, you are bringing the opposite to it. That makes it not to be right. What I said that, what can how can you have unmodified opinion in an modified report? That was my question. Do you get it? And your response was that the account is materially misstated and there is limitation of scope. That is why the account is modified report. And I don't know the way you put that's why I explained the question. But
Yeah,
in all honest, yes, you might have that's why I said you have the idea, but the way you put it is totally wrong. And I did not see your idea in your brain. It is what you wrote or what you say. That is what I'm going to use to mark you. So that is why I said you were wrong. I know you have the idea. Do you understand now, man?
all right, sir.
All right. So I know many people will have ask questions. Okay, Tulia, please can put down your hand, man. Thank you. So Olanike is not there. Mr. Okechukwu, please, you have the floor now, sir.
Okay, sir. Can you hear me, sir?
I can hear you.
Okay, sir. To me, I actually I understood what you said, but I thought their question was in a situation whereby someone can issue unmodified reports in a situation whereby the modification
Okay. Now
conditions are
see your question. Your question is you can never have modified opinion in an unmodified report. It is not possible. Modified opinion means that the account is materially misstated and there is limitation of scope. You are now putting it in an unmodified report. It means that you are saying that the account is materially misstated that there is limitation of scope. But however, I'm giving that the financial statement is not fair view. No. So that is the aspect you are explaining to. That is why I said you were wrong. You miss it opposite side. You can never have modified opinion in an unmodified report, but you can have unmodified opinion in a modified report.
okay.
Please, are you getting me, everybody?
Okay. Okay.
The reason why I said this chapter is very, very tricky. I know experience is a guide. That is why I'm taking my time. Omi, please, you have the floor. I don't have this much time. All of this question. Tommy, you have the floor. I don't know how to pronounce this now. Okay.
In this case, when we have unmodified report, modified opinion, which of it will they show that all this is an accounting statement rely upon?
You say what? Report. I can't hear you. I can't hear you. Please explain your question.
In this case, if you have these two kind of report in an opinion, which one will the initial financial statement rely upon now?
If I tell you that, I can't hear you. Please type it. I can't hear you. Yeah, the thing was just making I can't hear.
Okay, sir.
Okay, so okay. Please, you can put down your answer, Mr. Tommy. Okay, please, you have the floor.
All right. Good afternoon, sir. Thank
Good
you
evening,
for your
ma.
time. All right, sir. So can we call this as unmodified reports, but except for subject to how can we relate this your statements with this, sir?
Okay. Okay, please let me hear your question again.
The statement that we just mentioned to us, that unmodified opinion in a modified report. I said, can we relate this to unmodified report but subject to a particular issues or except
No,
for
it is
is
not
it can
possible to have, see, unmodified. There are some conditions that make you to be unmodified. But when the account is materially misstated and limitation of scope, it supersedes the account to be true and fair view. You are not saying that the account is not true and fair view, but these two conditions make you to give them modified report because the account is materially misstated. When the account is materially misstated, it means that all those figures, they are not correct. When they're supposed to have 10,000 naira reported, for example, they are putting on 100,000. That is material. So you cannot place reliance on it. And also, the document that will make you to vouch that oh, it is not actually 100, though, it is 10. There is limitation to it. It means that when you are requesting for 10 documents for you to substantiate that, oh, for me to get to the root of this thing they reported in the financial statement, you requested for 10 documents. They gave you 2. That is limitation of scope. You know, that 2 cannot substantiate that you have gathered enough evidence for you to form your opinion. So that is why you are given modified report. The account is clearly presented true. The account is not misleading. There is no error. Clearly presented. It's not misleading. But there is material misstatement. That is why you are issuing what? You are issuing modified report in unmodified, or there is unmodified opinion in a modified report. But you can never have modified opinion in an unmodified report. Everybody, are you getting me? This thing is very, very straightforward. Very, very simple and straightforward. Anyways, haven't you understand that? Please let me see your emoji if you truly understand this statement I just explained now. Everybody, please. I don't want to hear I did not understand though, this one, that one. Okay. So now that we understand that, and we have understood also the criteria that can warrant an auditor to issue modified report. Let me see. Who is raising up his hand again? Mr. Godwin. Okay. Good evening, sir.
Yes, sir. Thank you very much, sir. So I want to quickly ask a question.
All right.
From your explanation, sir, it means that
Okay.
difference between audit opinion and audit report.
Yes.
Because it's like you can have one in another one, and you may not have one in another one. So audit opinion is
Yes.
audit report.
Yes. Opinion translates to report in some way. Then opinion cannot actually be translated to report in another way. This is the way one, where opinion can be translated to report. If you are satisfied that truly, in your opinion, all this might work, or all this stick that I need to be followed in order for me to give that this account is okay, has been certified, then in your opinion, you are saying that this account is true and fair view, then you are translating it to the report. After you have certified that the account is true and fair view, then you are giving an unmodified report. It means that the account is free from material misstatement and there is no limitation of scope. Do you get that one, Mr. Godwin?
Yes, sir.
Then again, where I said you cannot have modified report in an you cannot have modified opinion in an unmodified report. Your opinion is this account is materially misstated and there is limitation of scope, which makes you, in your opinion, you have already decided that this account is not true and fair view. That is your opinion. So your opinion will not be translated into report. And the report you are now giving that due to this condition that are present, yeah. Who is this Temitope now that is disturbing us? Eh?
I don't do it. Not a good one. It is in the copy. Because even
Okay. So what we are saying in essence is that the account is materially misstated and there's limitation of scope. That is your opinion, and your opinion is this account is not transfer due. That is your opinion. It is that your opinion you now translate into what? Into your report. Do you now understand now, Mr. Godwin? Unfortunately, I've muted everybody because of that interpreter that was disturbing us. I don't know. Simple question, simple instruction. Mute your mic when you are not allowed to talk. Eh? We are professionals here now, and this is giving me a because by the time I'll be explaining and someone will be somewhere be disturbing, I will just lose my concentration. I will not know where I thought and where to start from again. This is not right. I hope that interpreter is listening now. Okay, so let us go. I refuse to be angry this evening. Let us go. So let us now go to the type of modified opinion. This is where you now understand it very well. This is where you now understand it very well. Let me close it first so that you not say, yeah, our guy is reading from me too. Let me close it. Let me explain first of all. So there are three types of modified report. There are three types of modified report or opinion as the case may be. Sorry, excuse me. Okay, so sorry about that. Now, I said this modified report or opinion, there are three types. We have modified opinion, which is one, adverse opinion, which is two, and disclaimer of opinion, which is three. You see that modified. When you are giving modified, it means that the financial statement is materially misstated, quite all right, and there is limitation of scope, but it does not affect the entire financial statement. That is modified opinion. I am saying again that this modified report, it has three types. We have modified opinion, we have adverse opinion, and we have disclaimer of opinion. I will now explain one after the other. One, modified opinion. The modified opinion, you can give modified opinion that in a situation whereby the financial statement is materially misstated, quite all right, and there's limitation of scope, quite all right. But these two elements does not affect the entire financial statement. That is modified opinion. Please, if you understand that, like as I explained like that, please let me see your emoji. If you understand that, as I explained, let me see your emoji. Let me say it again. Modified opinion as type of modified report is a condition or a situation whereby an auditor is giving an opinion where the financial statement is materially misstated and there is limitation of scope, but this material misstatement and limitation of scope does not affect the entire area of the financial statement. That makes it to be what? To be modified opinion. Number two, adverse. Adverse opinion. It is an opinion or type of modified report whereby the financial statement is materially misstated and there is limitation of scope. And these two elements affect the entire area of the financial statement. The modified, it does not affect the entire area, but adverse, it affects the entire area of the financial statement. Do we get it? Please, we understand that adverse too. Please let me see your emoji. I will say it again. Adverse opinion, it is type of modified report whereby financial statement is materially misstated and there is limitation of scope. And also, these two affect the entire area of financial statement. Then you are giving an adverse opinion. Lastly, disclaimer of opinion. Disclaimer of opinion is also type of auditor's report, which is a situation whereby the financial statement, there is limitation of scope. It means that the auditor were unable to obtain sufficient appropriate evidence to conclude whether the financial statement is free from any material misstatement. See that it only relates to limitation of scope. That is, the auditor were unable to gather substantial evidence to form his opinion whether the financial statement is free from any material misstatement. Thereby, you are giving disclaimer of opinion. Please, if you understand this theory, let me see your emoji. So that you don't say, it's what is reading, Gary. Not be today, sha, but we thank God. The most important thing is,
Please,
you must be able to understand it.
please
Mr.
repeat
Patrick, please, if you
disclaimer.
have a question,
Repeat disclaimer.
if you have a question, raise your hand. It is very, very simple. Let us be professional. Yeah. Let us be professional. Look at it, please, you have the floor.
Sorry, good evening, Mr. Idris. Please, I don't understand the thing that you explained here. I don't understand them.
Which one?
Because
Which one?
my network was bad. 3 of them. My network was bad. I just come in back now. So
Is it that you don't understand or you not hear?
I did not hear, but is the network is going.
Okay, let me re-explain. These 3 type of opinion. Yes, these 3 type of opinion. Please mute your mic, man. I'm sure this thing will also answer Mr. Patrick's question. So, Mr. Patrick, it will also answer your question, so you can put down your hand. You said I should explain the adverbs of opinion. Abi? So, if it is
Yes,
like
sir.
that, I'm going to re-explain the theory again. Now, modified opinion. This is a type of audit report. This is a type of modified report, rather, whereby the financial statement is materially misstated and there is limitation of scope, but this the material misstatement and limitation of scope does not affect the entire area of financial statement. If there is a condition like that, whereby the material misstatement and limitation of scope does not affect the entire area of the financial statement, then you can give modified opinion. Required, if you understand that, please let me see your emoji. If that one is okay. All right. So now, the second one is adverse of opinion. I will just say that since that adverse, it means that the material misstatements and limitation of scope affect the entire area of financial statement. Then, if it is like that, you are given an adverse opinion. The first one is modified. It means that it does not affect the entire area, but in adverse, it affects the entire area of the financial statement. If you understand that too, let me see your emoji. Require. Now, the third one is limitation or a disclaimer of opinion. Mr. Patrick, please listen very well here. Disclaimer of opinion is a situation whereby the auditor is unable to obtain sufficient appropriate evidence to conclude that the financial statement is free from any material misstatement. That is when there is limitation of scope. You are unable to gather substantial evidence to form your opinion that the financial statement is free from material misstatement. Then you are giving an adverse disclaimer of what? Of opinion. Do you understand that one? That is, that disclaimer of opinion work with limitation of scope. And limitation of scope indirectly will lead to material misstatement. Limitation of scope, you are telling them that you are unable to gather substantial and sufficient evidence for you to conclude that the financial statement is free from any material misstatement. Then thereby you are giving a disclaimer of opinion in your report. Do you understand, sir, Mr. Patrick? Please let me see your emoji. If you understand that, Mr. Patrick, he has disappeared again. See now, person asks question now, he disappeared. However, so let us proceed. So let us not modify. Okay, all this
I'm good to
question.
go, sir. Thank you, sir.
Okay, we'll not finish this question on time. Mr. Wasil, you have the floor, sir.
Okay, sir. Thank you very much, sir. Please, I would like you to help me repeat this disclaimer opinion. I did not understand it properly. Thank you, sir.
Do you understand limitation of scope?
Yes, I do.
What is the limitation of scope?
It is a situation whereby the OM in doing the audit procedures, the things we are supposed to do, the things we are supposed to carry out, most of it were not provided for us to do.
So then, if you are not provided, can you just say that, oh, because you asked for 10 documents that they gave you 2, can you conclude that the financial statement is okay like that?
No.
So it becomes so that means that there is limitation of scope, Abi. So it
Yes.
is on that you are now giving your opinion that I'm giving this opinion because I asked for 10 documents, they are giving me 2. And these 2 they gave me cannot be enough for me to conclude that the financial statement is free from any material misstatement. That is why I'm issuing disclaimer of opinion. Disclaimer in the sense that it is not at your own detriment to use the financial statement, because I'm saying categorically that I don't have substantial evidence for me to form or for me to conclude that the financial statement is free from any material misstatement. Disclaimer is just like you have to, if you have written case study before now, yes, they said during your after your executive summary, in your executive summary, you also put disclaimer. Disclaimer, you are telling them that this financial statement or this report is for internal use only. It means that it's not for external. So if external get up to that report and he use the report for his own decision making and the thing later goes bad, so the person that present the report will not be held responsible because that's already put disclaimer that this report is for internal use only. Will
Okay, sir.
anyone? Someone is telling me that it's not in cover page. Is it in cover page? Is it not inside the executive summary? I don't know, Jerry. It's been a while. I wrote a case study. So anyway, I shall note that there is disclaimer in your report. So, Mr. Wati, I hope you understand very well now.
Yes, I understand, sir. But the only but I have is, can you do me one more favor of divining it in an examination situation?
Well, okay, yeah. Let me now scroll to the material. Do you have the material with you?
No.
So you don't have the material, so you will be listening through this one. So let us go. Let me now. I only explained that one in my mouth. So now this is the real definition. The exam. Maybe you want the exam one, no, Abi. This is it. So yeah, let us read through it. There are 3 types of modified opinion, and they include 1, qualified opinion. Yes, I meant to say qualify, not modify. That person I mentioned. So for you that you now be correcting me again, I meant to say qualified is a type of modified opinion. So I meant to say qualify, not modified. I was using in the first place. So let us go. Qualified opinion. This opinion is given when the auditor opinion that there is material misstatement or limitation of scope and the effect of and the effect on the financial statement is material but does not affect all areas of the financial statement. See the exact one on here. They said you can give an unmodified opinion whereby there is material misstatement and limitation of scope, and these 2 they are material in the financial statement but they do not affect the entire area of the financial statement. Then the auditor may declare true and fair view except for a particular matter. So this is where we are now saying that you can have unmodified opinion in a modified what report. This is, they said the auditor may declare what true and fair what view except for a particular matter. Except for a particular matter, I will now make it to give you what to now make it to give it what modify report. Please, are we following everybody? Please let me see your emoji if you are following. Do we understand? Yes. Can I proceed? Yes. Okay. Number 2, adverse opinion. This is given when the auditor opinion is that the financial statement as such that there is material misstatement and such misstatement affects all areas of financial statement or the materiality is significant to the auditor. That is, it affects the entire area of the financial statement. Then you can give an adverse opinion. So, Wasiu, this is the exam one, disclaimer of opinion. This will arise when the auditor is unable to obtain sufficient and appropriate evidence to reach its opinion, and such inability is across all vital areas of the financial statement. Wasiu, Mr. Wasiu, do you understand now, sir?
Thank you very much, sir.
All right. So, for us to understand this concept very well, let us see. I now give us small diagram to help us explain this situation so that we understand very well. So, let us go. Now, see, let's see. Matter, okay. Matters, nature of matters to modification. We have financial statement materially misstated. We have inability to obtain sufficient and appropriate evidence. You now said material but not persuasive. That is, when something is material but does not affect the entire area, what are you giving? You are giving qualified opinion. But if it is material and persuasive, that is, it is material and affect the entire area, you are giving adverse opinion and disclaimer of what of opinion. This diagram now explains categories where you can give qualified opinion and adverse and also disclaimer of opinion. My dear professional, please, do we understand? Do we understand, everybody? Can I proceed? Yes. Any question? No question. So let us go. Now, emphasis of matter, I've explained it before. We have explained before on Wednesday. So, and I said that we still explain the emphasis of matter very well. So, also are the examples or conditions that might make us to have emphasis of matter paragraph. So, the emphasis of matter is also things that you need to be reported in your financial statement if they are present. But you report them as a paragraph, not like a whole body of reports. It will come as a paragraph. So how do we relate to that? Let us go. And so emphasis of matter. So which ISA talk about emphasis of matter? Everybody. Which standard is that? Which standard though?
ISA 706.
Okay, thank you. Thank you, Funke. Okay, you can mute your mic. Thank you. So the standard that talks about emphasis of matter paragraph is ISA 706. Now let's go. When an auditor report contains emphasis of matter paragraph, the opinion is not modified. Yes, it's not saying that the account is materially misstated or there's limitation of scope, but it means that the auditor has obtained sufficient appropriate evidence that the matter is not materially misstated in the financial statement. But where the matter is materially misstated, modified opinion is required. So let us go. Circumstances where emphasis of matter paragraph is necessary. The following are examples of some circumstances for emphasis of matter paragraph. One, where an uncertainty relating to future outcome of exceptional litigation or regulatory action. That is, they are not giving us the example of what emphasis of matter. Two, a significant subsequent event that occur between the date of financial statement and also date of audit report. So this subsequent event, which is event after reporting date, is covered by IAS 10 and also ISA what? ISA, I think it's ISA 550. Yes. ISA 550 talks about subsequent events. Then ISA 510 and 710 talks about comparative figure and opening balance. Okay, so I'll stay on the way. Let us go. A significant subsequent event that occur between the date of financial statement and date of audit report is also an example of matter emphasis of matter paragraph in our auditor's report, where there is new IFRS adopted, where the company just adopt new IFRS and they incorporate it in their financial statement, then it shall also come as emphasis of matter paragraph in our audit report. And lastly, to draw attention of occurrence of a what catastrophe, that is something that can make the account or the company to collapse or to have bring issue to the company, such as this number one, uncertainty related to future outcome of litigation. Oh no, going concern when the account, when the company has been making loss, and you are trying to draw their attention that this company has been making loss for the past 7 or 5 years. So it means that something is not right, and if the company continue like this, the company might not last long. So these are the conditions or circumstances that can warrant you to give emphasis of matter paragraphs in your auditor's report. Are they professional? Are we following? Yes. Can I proceed? Yes. Do you have any question? No. Are we enjoying the class? Yes. Let us go. Okay. So, other information. What is other information? This other information is covered by ISA 720, other information and auditor's responsibility. So this other information and auditor responsibility is covered by ISA 720. Let us go. These are information that are not required by accounting standard to be published, as they may not be financial or directly related to audit. The scope and content of audit exercise is usually stated. However, both reported information and unreported or unaudited information may be checked by the auditor for consistency. Where the auditor finds error or inconsistency with the unaudited information leading to material misstatement of the other information as ISA 720 requires, the auditor to ask the management to correct the information. If management refuses to make correction, the auditor needs to communicate with those charged with governance to make correction. What we are saying here, other information. You see, there are those information or those parts that the auditor does not check or audited, or it was not reported in the financial statement. Let me say, the auditor does not check. You know that we cannot check all the whole transaction. So we can check significance by our materiality, maybe at least 80%. And the 20%, let's assume the 20% is unaudited, we will not touch it. So then the auditor needs to be checking this thing at a regular interval for consistency to make sure that this 20% that will not touch, I hope this 20% does not even form materiality or does not make bring substantial error to the financial statement. The auditor needs to check. So in a situation whereby those parts that we did not audit or we did not check now later bring material misstatements to the financial statement, because they said here that auditor needs to be checking at regular interval for consistency. Although we did not check, but we need to be checking that, this other part or this figure that we not touch, I hope it's still the same thing. I hope nothing has changed. So if there's changes or we find out that this thing has later lead to materiality or has later lead to material misstatement in the financial statement, we need to communicate with the people that is in charge of the organization governance. That is, we need to communicate with people in charge of the organization's activities. So those are the matters that can form other information in the auditor's report, and those are the things we refer to as other information. Do we understand this part, everybody? Do we understand this part, everybody? Hello? Yeah. All right. How much you understand that? We are moving on. We are moving to ISA 710, which is comparative information. Don't forget, we have dealt with this thing under chapter 6. Chapter 6. Why should I explain again? These people, okay, let me re-explain again. Other information. There are those information or the part that we did not touch during the audit process. And we auditor, our responsibility is to be checking it for at regular interval if there's any inconsistency. Inconsistency means that the way they've been reporting it before, they not report it this way again. And there is that part that we don't use to touch, like all those disclosure in the financial statement. We are not touching them. It is unaudited area. It's what they give us. But we have to make sure that this thing that we not touch still remain the same, except the exchanges. So ISA 720 now talks about other information and auditor's responsibility. That is, the other information has to go with those parts that we did not touch, which is especially maybe disclosure in the financial statement that we did not use to audit at all. But we need to check them for consistency, that I hope this thing has not changed. So eventually, if the thing later change, and it will later lead to material misstatements on the financial statement, then our responsibility is to report to the people in charge of governance for necessary correction. That makes it to the other information and our responsibility. The other information means that the financial statements are the unaudited financial statement or unreported part of the financial statement. We did not touch it, or there's no report on it. But our responsibility is to be checking them consistently. And if after checking now we find out that this thing has not been the way it has been reported before, we need to now, our responsibility again is now to communicate that inconsistency to the people in charge of governance for necessary correction. That is that about ISA 720 on other information and auditor's responsibility. So if there's something like that, any clause like that, it needs to be reported in our audit report. Yes, thank you. You said you understand now. So, comparative information. We have dealt with this thing under our audit approach. Don't forget, we said financial statement approach. Our financial position approach. And under financial position approach, the main emphasis there is that we will have to check if the closing balance for previous year is correctly transferred as opening balance for this current year. That makes it to be that's one of the approach that we can use as our audit approach. Now, this thing now talks about it, comparative information. The comparative information here means that if you have seen financial statement before, if you are auditing 2024, then they will also bring comparative information, which is figures for 2023. They will be comparing it for side by side. So, meaning that in the financial statement, there will be this information for this current year, and there will be information for last year. That makes it to be comparative information. So what does ISA 710 say? What does IS say under comparative information if it is available? Let's see. The audit opinion shall not refer to the corresponding figure, or else the following circumstances apply. Then ISA 710 now says that these circumstances can be referred to when there is disagreement in the following figure, or the audit opinion shall not refer to the corresponding figure. The same it shall not refer except in the following circumstances. One, where the auditor has gave qualified opinion in the previous financial period and the problem remains unresolved, then ISA 710 requires the auditor to modify this year audit report. This is what we are saying here. This thing is very, very simple. Now, let me explain that first one. The auditor give qualified opinion last year. Qualified opinion means, from my explanation, that there is material misstatement and limitation of scope, but does not affect the entire area of the financial statement. If we give qualified opinion last year, and those material misstatement and limitation of scope, which is supposed to, don't forget that they said that before an auditor can issue modified report, it means that the matter must have been communicated to the management, and the management did not do anything to it. When you first spot it, you cannot just issue a report like that. You have to call a meeting between the management and tell them that, oh, this is what you find out. let's make necessary adjustment. It is after the adjustment you now know whether you now going to issue unmodified report or you still remain modified report. So they said you can give unmodified report or you can give modified opinion in the following situation as required as regulated by ISA 710, where the following information or where the following issues are what are present. One, where auditor gave a qualified opinion in the previous financial period and the problem remain unresolved, then ISA 710 require the auditor to modify this year audit report. It means that you automatically you give modified audit report. It means that what you reported last year that's supposed to have been changed and be reflected in this year account, it has not been changed. Then you are giving modified report this year because the last year thing that you said they should change did not change it. Meaning that the error we will still be transferring to this year account. It means that I shall announce that if there is a situation like that, you should give modified audit reports for this year. Please, do you understand that statement, everybody? Yes, it is very, very straightforward. Number two, where the auditor finds a material misstatement in the prior financial statement on which unmodified opinion was previously given, the figure has not been stated, then ISA 710 require the auditor to give qualified or adverse opinion on the current year financial statement. This is what we are saying. This is what we are saying here. This second one, it means that the account is materially misstated. But you now find out that last year, last year they give unmodified report or unmodified opinion. But when you are not doing your comparative comparison, you will now see that there is material misstatement in the account that they give unmodified opinion for last year. So if there is any issue like that, then you should what? You should then ISA 710 require you to give either adverse opinion or modify or qualified opinion in this current year financial statement. I will say it again. The account has been audited last year, but the auditor gave unmodified opinion. So during your comparative checking, you now find out that this account that they give unmodified opinion for last year is materially misstated. There is error. It is not transfer view. And they have been given, they gave unmodified opinion on it last year. So the ISA 710 now require you to give, if you have substantiated that this account is truly materially misstated, and they give unmodified opinion last year, then ISA 710 require you to give adverse or qualified opinion for this current year financial statement. That one is also very, very straightforward. Do we understand, everybody? Yes. Let us go. Number three, where the prior financial statements were audited by another auditor, then ISA 710 require the new auditor to use other matter paragraph to explain any fact and give its opinion. It means that where the financial statement was not audited by you or was not audited by your firm last year, so the auditor is required, in accordance with ISA 710, to use other matter paragraphs. Remember the other matter paragraph, which is covered by ISA 706 revised. ISA 706 revised. It's other matter paragraph I've explained before. So if there's any situation like that, then the auditor is required to give other matter paragraph to explain any fact and give its opinion. So lastly, in accordance with ISA 710, where prior periods were not audited, then the auditor may still use other matter paragraph as the auditor is responsible for obtaining sufficient and appropriate evidence. This is what we are saying. Where the financial statement was not audited at all last year, and this year now, the auditor is required, in accordance with ISA 710, to state it in other matter paragraphs and also need to obtain sufficient and appropriate evidence in that regard and to form his opinion for this current year. So, my dear professional, these four statements are very, very well explanatory and very, very straightforward. And that is that about ISA 710 on comparative figure. We still have a long way to go. I hope we can finish this chapter today. We have to finish it. Me, I'm tired. Yeah. Now, impact of going concern on the auditor's report, ISA 570. Yes, ISA 570. Going concern. So what is it? Let us go. If there is going concern, are we going to report it in our auditor's report? Yes. What modification? Let us see. The auditor is regularly expected to review the client's financial statement on going concern basis. If indication are found which suggest that the going concern basis might not be appropriate for the client's financial statement, the auditor is required to consider the implication for his audit opinion. Who is that? That person should meet it on Michael. Okay, let us go. So the auditor could take any of these two views. One, going concern assumption. We talked about this assumption, I think, in chapter 5. Yes, going concern assumption. Going concern assumption is appropriate. So let us go. Please, can you hear me? Can I proceed, please? All right. So the auditor could take any of the two views. Going concern assumption is appropriate but material uncertainty exists. Where auditor consider that going concern assumption is appropriate but materially uncertainty exists, he must consider whether the financial statement adequately describe the principal event or condition that may cast significant doubt on the entity ability to continue as going concern. This is what we are saying. Going concern assumption, it is the company used to prepare the assumption. That is, the assumption used to prepare that, oh, this our account or this company will continue to be in existence till eternity. That is the assumption. So they now said, where there is material uncertainty that this company will not be able to be in operation till eternity, but they have already given the assumption that the company is going to continue till eternity. But during your review, you now find out that the company has suffered materially uncertainty for going concern. Then they now said that the auditor should describe the condition that may cap, or it should give condition that may give circumstances for the company not to continue as going concern. This is what we are saying. The going concern assumption has been prepared by the management, but during your review, you will now find out that there is material uncertainty for going concern. It means that certainly the company might not be able to exist till eternity. So you, as an auditor, you have to give the event or condition that may warrant the company not to be in operation till eternity, based on what you have reviewed in the financial statement. That is what they meant by that, by this word, that the auditor has to describe the principal events or conditions that may cast significant doubt on entity ability to continue as going concern. That one is very, very simple. The other condition, basis for opinion. So the now said the paragraph is entitled, you now put it as materially uncertainty relating to going concern. This section will highlight the uncertainty, draw attention to the relevant note in the financial statement, and also state the audit opinion is not modified in respect to what? Is not modified in respect to this matter. If there is no adequate disclosure of uncertainty, that is, if they did not disclose this going concern disclosure in the financial statement, that's why they said if there is no adequate disclosure of uncertainty, then the auditor shall express qualified or adverse opinion. In this case, the auditor will not include a separate material uncertainty relating to going concern, because the material uncertainty will have been fully explained on the basis of adverse opinion section. This is what we are saying here, that the basis of opinion. So certainly there's a paragraph that must be titled as material certainty related to going concern, that should form under emphasis of matter, if you could remember, as one of the examples. But after everything, you now see that there is no adequate disclosure. So during your review, you now see that the company did not even disclose at all, did not make assumption at all on the going concern assumption. They did not make disclosure at all. But during your review, you now found out that the company has been making loss, heavy loss for the past 5 years, and the company did not make the assumption. So ISA 570 require the auditor to give, modify, or add to give qualified or adverse audit opinion in that regard. Please, are you following? Please, are you listening to me? What we are saying in essence that this other one, in your opinion, in the opinion basis, there will certainly be material uncertainty for going concern, yes, which form part of our example of what? Our example of emphasis of matter. But in this situation, the going concern assumption was not produced by the management, and there's no appropriate disclosure of uncertainty of there's no appropriate disclosure of material uncertainty of going concern in the financial statement. Then, if you have seen like that there's no going concern assumption and they did not disclose it in the financial statement, ISA 570 require the auditor to give either qualified opinion or adverse opinion on the what, as opinion in the what, in the auditor's report. Do we understand this other one, everybody? Do we understand? Okay, so how would you understand this? Now that we have substantially understand it, let us now go to ISA 260. How can we communicate? So how do we communicate some of the efficiencies to the management or to the people in charge of governance of the organization? For any issues or for any error, how do we communicate? And which standard covers it? ISA 260 cover it. So let us go. The auditor is expected or required to communicate to shareholder by means of auditor's report. For a company, the auditor is expected to communicate with board of directors or the audit committee. So objective of communication. Why are we communicating to the people in charge of governance? One, to communicate his responsibility and give an overview of the plans and scope and timing of audit. The reason why we are communicating is to what? To give our responsibility, to give an overview of the plans, scope and timing of the audit. Two, to obtain information relevant to the audit. That's why we are communicating. Three, to provide timely observation arising from audit, which are significant to management responsibility to oversee what? The financial reporting process. And four, promote effective communication between the auditor and those charged with governance. So after we have understand the reason why we're supposed to communicate with people in charge of governance. So how do we communicate? What circumstances that can make us to communicate? One, let us see. And this is the same thing. So the auditor is now required by ISA 260 to communicate the following: his responsibility relating to audit, which is number one. Two, overview of the plan, scope, and timing of audit. I've explained this. Is still the same thing what we explained in the earlier on. Then any significant finding from the audit, including the efficiencies in internal control. And four, compliance with relevant ethical requirements. So ISA 210 is it okay? 260. ISA 260 talks about communicating with the people charged of governance in the organization. While ISA 265 now talks about communicating the deficiencies in the internal control. If there are deficiencies in the internal control, how do we communicate? That is what we want to discuss now. So let us go. A deficiency by ISA 265 as we are control can be defined as control. Okay, or as we are a control is designed or implemented or operated in such a way that it is unable to prevent or detect and correct material misstatements in the financial statement on a timely basis. This is what we are saying. The efficiency by ISA 265, it means that the control that is designed, that is implemented, that is operated, is unable to prevent and detect correct material misstatements in the financial statement. The efficiency means that the program they set aside, the policy, the design policy, the implementation, the program, the way they operate it. After everything has been put together, those things were still unable to detect and correct material misstatements in the financial statement. Then it leads to the efficiency. Do we understand that simple part? That is the program we implemented, everything that we put together to work fine in the organization. Those things are still unable to detect and correct material misstatements. That becomes the efficiency. So let us do a significant deficiency. When something is not significant, it means that it is material. A significant deficiency is a deficiency or combination of deficiencies in internal control over financial reporting that is less severe than material weakness, yet important enough to merit attention by those responsible for oversight of the company's financial reporting. This is what we are saying here, that significant deficiency is the deficiency or combination of deficiencies of in internal control over financial reporting. ICFR. We used to call sometimes is one of the reports that we always request from the client to produce for us during audit is what we call ICFR. ICFR is telling us that the internal control that we have is implemented and is operated in a way that it is capable of spotting or correcting material misstatement. That is the report, and it is called ICFR. So we now said that the reason why we are now reporting this thing is to let the management know that the implementation procedure or the operated procedure that were put together were unable to detect material misstatements. That is why we are communicating to the people in charge of governance. So ICFR, it means internal control over financial reporting. It simply means that the organization have substantial right to establish internal control to oversee the financial reporting for audit purpose, to oversee and correct any mistake or error or material misstatement in their financial statement. That is why we call it internal control over financial reporting. So, however, if there is the efficiency in this department or this department is unable to correct material misstatement, it has to be reported to those in charge, those put in charge of governance of the organization. That is that about communicating the efficiency in internal control as stipulated by ISA 265. So let us go. The communication of significant efficiency must be in writing and required to cover one, the description of the efficiency and explanation of their potential effect. Two, sufficient information to allow those charged with governance and management to understand the content of the communication. And three, and that is about Communicating the efficiencies in internal control. First of all, we have to make a description of the deficiency and the explanation of their potential effects. And two, sufficient information to allow those charged with governance and management to understand the context of the communication in order for them to work to do what is necessary to correct the efficiency. So lastly, we now have management letter. You see this management letter, I'm sure in chapter 6 or chapter 7, yes, chapter 7, we have substantially discussed about some letters that we have or that we use to communicate to each other between the auditor and the client to ourselves. We mentioned 5. Then I can remember. We mentioned appointment letter, we mentioned engagement letter, we mentioned arrangement letter, we mentioned letter of representation, and this is the last one, management letter. So don't ask me, because I know I've substantially explained those 4 parts of 4 letters before. The appointment letter, the engagement letter, the arrangement letter, letter of representation, then this last one is the management letter. You see, this management letter is very, very important. Let me just explain that management letter. The management letter is that letter that you send to the management from the auditor, whereby you record all the things you observe during the audit process or during the audit period. Everything you observe, you put it in the management letter. The effect of that thing that they are not doing very well, the level of error, whether it is high, whether it is medium effect, whether it is low, you put it there. And you also recommend better way to do those things right. Everything, it will be there in the management letter. Then it used to have 4 areas. First of all, you give the observation. 2, you give the effect of the observation. And 3, you give the level of that effect, whether it is high or low. And 4, you produce the recommendation. So you now leave one space, which is management response. And it is that you now send it to the management. Then the management will now read through it, and they will tell you, oh, this thing will make correction in the current year. The next will do this. The one that they can do in that current year, they will do it and they will send it back to the auditor for you to see that, oh, they said they are going to correct this thing. They said they will do this thing right. They said they will do this right in the next account, or they will correct it on the financial statement. So management letter in a nutshell is that letter that is used to communicate your findings in audit to the people in charge of governance. And in that management letter, there will be your observation, what you observe. There will be the effect of that thing that they are not doing very well. Then you give the level of effect, whether it is high or low. Then you also recommend the better way to do that thing right. Everything will be included in the management letter. So I'm sure you understand that management letter in that nutshell, the way I just explained. Everybody, please, do we understand? I know we are tired. So let us go. Now, the management letter is seen as a letter or report to management to communicate the efficiency in audit management. It is an external service provided to clients by external auditor. It is also known as letter of witness. The report is prepared and sent as the result of test of control and known after the internal audit. The report may later be updated after the final audit. It is further witness has been found in their witness previously reported or have not been dealt with. In line with ISA 265, the report will usually identify the following information: the efficiency, it means the nature of witness, what you observe, the implication of the witness, that's what I just explained now, the implication of what they are not doing very well. Recommendation for improvement, that is, you give them recommendation for improvement. Then also, the auditor shall ask the management to provide response and action plan for each of the witness identified in the report. It shall also mention that the content of the report will be followed up in the future audit. So that is that about the management letter. My dear professional, please, do we understand the aspect of management letter very well? So, if you understand, I have tried. I hereby tell you, everybody have substantially and appropriately give us the chapter review up to 90% for what we have in this syllabus for this diet. At this moment, after this chapter 14, I have explained substantially 90% of everything we need to know in advanced audit and assurance. So next week, inshallah, we will finish this syllabus. Then it means that we just finished 50% of part A. Then part B will now be on how to answer questions. Part A is to know what to write, which has covered 50%. Part B is on how to write, and we have to be very, very careful. That is where people used to fail, when you are unable to know what to write. When you are unable to know how to write, it is the major problem. For many people that have written this paper more than once, they will tell you that from this class, they have learned that the way they've been answering questions were wrong. That is why they have been failing. So that is why we are here together in APEC. We are going to explain, teach you on how to answer questions in the exam hall. So this is where we draw a curtain for chapter 14, which is the art of our exam, plus chapter 8, the audit evidence. And I hereby declare that I've substantially explained up to 90% of what we have in this in advanced audit and assurance for this new syllabus. And the other two chapters, we'll finish it next week. So, my dear professional, I hope everybody you understand everything we've said so far. That is why I took my time. If you add what we did, the class that we had in the previous class on Wednesday and this time together, we spent close to 4 hours, which we will have used to treat 2 chapters. But I took my time to explain very well so that we understand. And during our class, during our revision class, I've also said I have some question that is coming under this chapter. Please let us read very well. So this is where we are going to conclude our class for today. And thank you everybody for staying through, for listening through, and for exercise patience and for your contribution and your attention. So thank you everybody. We are going to meet next week, Wednesday, and we'll finish our class next week, Friday. So on this note, thank you everybody for staying through. And please, the material is for you, as I said. Some people just come to my DMs. How much is the material? I will tell them, they will just disappear. You will not hear from them. Like I said, it is for you, it is not for me. So thank you everybody. And if you still need the material, please reach out to me in my DM. Thank you everybody for staying through. Have a wonderful evening. Good night.
Good day, sir.
Thank you, sir.
Thank you, and God bless you.
Amen. You too.